All right, today we're going to be talking about finance strategies for maximizing profit. It's going to be a great video. You're not going to want to miss it.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium-sized businesses while controlling risk. So if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
All right. So we're going to start off today with a little bit of a background. The title is Finance Strategies for Maximizing Profit. Where did this topic come from? Well, it was generated by AI, who says that this particular title is filled with keywords that are going to help this video get lots of views. So I kind of spent the weekend thinking about this title because I was like, what exactly does this mean? Finance strategies for maximizing profit. Well, let's break it down, and then I'm going to get into the meat of the content. So, maximizing profit, pretty easy, right? So, if you think about any business, we want to have high sales and we want to sell things with a good gross margin or markup such that we make money off of each customer that we serve through a sale or a service, sale of an item or a service. And we want to keep our expenses as low as we can so that there's lots of money left over, right? So this would be a general description of maximizing profit. Now, what then are finance strategies? So finance strategies, we would need to figure out first what a financing activity was in order to have any kind of intelligent conversation about a strategy, right? So if you think about a company's balance sheet, and I've made plenty of videos where I've shown you sample balance sheets, on the left-hand side, the asset side is all the stuff that a business has. Cash, inventory, machinery, equipment, vehicles, all the stuff, right? On the other side of the balance sheet, we have the liabilities. So these would be your accounts payable, your credit card debts, lines of credit, bank loans. And we have the equity, so the amount of money that the shareholders have put in or accumulated profit over time, the retained earnings. So everything on that right-hand side, the liabilities and the equities, that is describing how we are financing the assets. So financing activities relate to decisions around borrowing money, repaying debts, getting investor money into the business, or removing investor money from the business. That would be a disbursement or a dividend, for example. So these are the financing activities. It's everything to do with that right-hand side of the balance sheet, the debts or the equity. And so a strategy, a finance strategy for maximizing profit would have to do with how are we going to manage the way we owe money to people or the investors' money that's in the business? How are we going to operate these things in such a way that we maximize profit, right? So that's what the title of this video would suggest. So why did it take me a whole weekend to try to think about what I was going to talk about? Well, because when we talk about small businesses, we often are specifically choosing to ignore finance activities. Why do I say that? Well, because when we look at small businesses as buyers or as sellers, we're typically looking not at the net income of the business, which would include everything, including taxes and interest costs and all that kind of stuff. We add those things back. And what we say is we say, hey, the taxes that a business pays or the interest that they pay, these are all the result of management decisions. And so when we own the company, our interest costs, our taxes, all this kind of stuff is going to be different based on how we manage the company. When we make a statement like that, what we were literally saying is we're acknowledging that the current owner's financing strategies are playing an important role in the net income output of the income statement or the P&L. Okay. So um, literally the definition of seller's discretionary earnings is EBITDA, which is the earnings before interest, taxes, depreciation, and amortization. Some of those things are finance related, right? And then we add back the owner's salary, which may or may not be a market rate of compensation, right? So we're adding back all those management based decisions. If you're not familiar with what I'm talking about, go and watch the video that I made called "Why SDE is Not Cash Flow," and it breaks down precisely what I'm talking about here and helps you understand. So if we are going to think about small business and we're going to think about it within the context of the vernacular and language that we are typically using to discuss these small business deals, then the very first thing that we have to understand is when I say maximizing profit, um, do small businesses actually ever really want to maximize profit? Right? Because it would seem that maximizing profit is obviously the desired outcome that a business owner would have. But in reality, it's usually not the case. In fact, I've had a long history of talking with business owners who've worked very diligently not to maximize their profit. Okay. So let's dig in. And the first thing I'm going to do is identify three general groups of business owners. And what I have learned are typically their desired outcomes in maximizing performance, let's say. Let's make it a little broader. Let's call it performance. Um, and then I'm going to dive into each one of these specifically to talk about the finance strategies that would help them achieve these ends. So, for example, somebody who wanted to sell a small business, they might not want to maximize profit from a net income point of view. Rather, what they're trying to do is maximize their seller's discretionary earnings or their EBITDA, because buyers are going to look at the SDE or EBITDA and they're going to apply some kind of multiplier typically, and that's how they're going to value the business. So the business seller wants to maximize SDE or EBITDA. A business that has investors involved. So if you've got partners, whether they're active or passive, other people who are shareholders, those businesses also typically are not that interested in maximizing net income either. What they will try to do instead is maximize return on equity or earnings per share or dividends or disbursements per share. And to get a glimpse of that, all you have to do is find a YouTube channel somewhere where they're talking about large publicly traded companies. Because over at Walmart, they're not trying to maximize net income. They're trying to maximize ROE or earnings per share, right? And so what does that mean? Is it means that a company may, as a finance strategy to achieve this, choose to take on a certain level of debt, even though they might have profits available to pay off that debt. But if they paid off the debt, then their earnings per share would be lower because they would lose the advantage, the financial advantage of the leverage that the debt brings, right? So this is starting to get at what I'm talking about, how different kinds of businesses are trying to maximize different performance points. So what about then sort of the long-term operator, the long-term small business owner, right? Because we talked about the sellers, we talked about people that might have investors involved in their business. What if you are just an operator long-term of a business? Well, I find that there are two sort of performance maximizing efforts that those kind of people will get involved with. Often they'll try to mix the two. Okay. So one is to maximize lifestyle, right? So when we talk about seller's discretionary earnings, we often get into the conversation of add backs. And so a lot of the times in small businesses, small business owners will do things in their business that don't strictly comply with tax rules, but are designed to maximize owners' benefit. So for example, and I use this example all the time, the small business owner who's into racing cars, and so they buy a race car in the small business, and all of the expenses related to the race car are expensed through the company, and they slap the company logo on it and they call it a marketing expense. But really, the race car has got nothing to do with the operations of the business, right? So that would be an example of an owner maximizing lifestyle, right? putting children's cell phone plans in the company, uh, finding every kind of reason why a flight to Florida has something to do with a business trip or something like that, all that kind of stuff. So that's maximizing lifestyle. The next thing that long-term operators try to maximize would be maximizing net income, which kind of leads to the whole topic of the video, right? But I wanted to get into some of the strategies that people would employ in trying to achieve these different things. And I've already mentioned a couple of them. So, business sellers want to maximize sellers' discretionary earnings or EBITDA. So, what might be a finance strategy for doing that? Because SDE and EBITDA ignore interest as a cost, right? What an owner could do if they were trying to maximize EBITDA is they could borrow money even if it was at a high cost. So let's say somebody used a credit card, 20% interest or whatever, um, to make an excessively large order from a supplier. Let's say that the business owner, instead of buying what they needed for the next month, uh, every month, right? So a regular monthly order for some product that they needed in the business. What they did instead is they ordered a 3 month supply in order to get a better price. And then they ended up paying interest on the credit card because they didn't have all the cash to pay it off within the billing cycle. So would that make sense? Well, a rational operator who's trying to maximize net income would say, well, how much money am I going to save on buying these materials versus what kind of interest cost will be there, right? And if you were going to save more than the interest cost, then this would be a rationally motivated decision. So the long-term small business operator could make the decision to do this, right? But someone who's trying to sell their business has an added motivation because the interest being spent on the credit card will not be counted against them, right? Because EBITDA specifically says earnings before interest, right? So someone who's trying to do everything they can to boost their SDE or their EBITDA could engage in activities that actually cost them more in interest than the savings on the material, but the interest cost doesn't count. All that counts in boosting the EBITDA is the savings on the purchases, right? So, so that would be an example of a finance strategy for maximizing performance in boosting EBITDA in getting a business ready for sale. Um, Long-term operations, for example, if you're trying to maximize your net income, you would measure whether or not it makes sense to do that, right? So let's say it was going to cost you $50 in credit card interest to do that exact purchase I'm explaining, and then you saved $50, right? So would it make sense to do it in that case? Well, if you are going to take everything into account and you're also trying to maximize your lifestyle, an added layer of consideration would be what kinds of bonuses or points am I earning on my credit card in or by making these purchases, right? So I've met many business owners who will they'll leapfrog from one credit card to another, and they'll purposefully try to corral a bunch of spending on the new credit card because oftentimes credit card companies will give you special bonuses of points or whatever if you get so many thousands of dollars of spending in the first 3 months or something like that. So if you're trying to maximize lifestyle, you might make a perfectly rational decision to cost your company money because the benefit you're going to obtain from that credit card point program could be far more than what the expense is within the business. And then if you also apply the layer of tax consideration, so for example, if you let's say you have a corporation in Canada or you have a C corp in the U.S., the corporation pays income tax, and then there's another layer of taxation when the money comes out of the corporation. People will then also say, hey, if I do it this way, I save $50, but when I take the money out of the corporation, it's going to cost me taxes anyway. So they also measure for that. Some people get very sophisticated about this, about figuring out whether it makes sense to purposefully burden the business with more expense in order to gain some kind of personal benefit on the outside. So, again, that is an example of maximizing performance from a lifestyle point of view. And so, long term, here's what I see very often when I'm dealing with business owners. Long-term profitable businesses, maybe there's a loan in the business. That owner will see the interest expense in their business and they'll think, geez, if I paid off the loan, I would save that interest, right? And so what they'll do is they'll start paying down the loan more quickly and they'll pay it off. And so I've seen many businesses that are very successful over the long haul that won't have any long-term debt in them. And that is because the owner is trying to maximize net income. And this is a finance strategy for maximizing net income. But what does that mean the balance sheet looks like? It means that the balance sheet, that split between liabilities and equity, is mostly equity. So the return on equity is very low because the entire activity of the business is being financed with the owner's own money, right? Which is actually the polar opposite of what they're trying to do in the big companies like Walmart or GM or et cetera, right? And so deciding what your goal is really important, right? And some of the things I've mentioned could be things that you want to look for in due diligence if you're buying a business that has a sudden increase in EBITDA, even though maybe the sales aren't going up, right? What did they do differently to cause EBITDA to go up? Was it because they are, employing some of these purchasing strategies, for example, to get better pricing? This is why when I look at businesses, I'm always looking at changes in revenue, but also changes in things like gross margin. And I look at every expense line, line by line. I look for changes year over year to see if there's anything that swings one way or another. So if a certain category of expense or part of the cost of goods sold were to change dramatically to the downside, so they get cheaper, right? So you say, hey, okay, the business is being better managed. They're making, better purchasing decisions. Well, you might want to dig into that. Like, why are they getting better pricing? I myself once worked in a small business where the owner paid his bills very quickly. So the supplier gave him 30 days to pay, and he would pay them more quickly than that. And then at the end of the fiscal year, when the supplier was trying to make their financial statements look better and they were trying to push additional volume of inventory on people, they would give him first crack. They would call him up and say, hey, we need to move some extra stuff. Would you like to buy a large quantity and we'll give you a better price, right? So he would have cash in his business and he would employ it to invest in these inventory savings. There's nothing wrong, illegal, or anything about this. But when you're going to buy a business, you want to examine this. Why? Well, because the way that that particular gentleman was running his business involved a lot more operating capital. He would have a lot more cash in the business, right? And so if you were going to operate the business the way that person did, and you were going to achieve the same results that they did, it would mean that in addition to buying his business, you would have to make sure you had that large amount of operating capital as well. And that would mean that your investment would be larger vis-a-vis the cash flow. So if you were going to operate that business with lower cash on hand and lower inventory levels, you would not achieve the same level of profit that he did, right? So yeah, as is often said, the business that you buy is different than the business that is sold because the way that you operate it, the strategies you employ, the finance strategies, and the capital that you have invested or are willing to invest may often be different, right? And so, um, in the world of looking at the return on your investment, if the investment is bigger, then your return on investment is going to be lower. So remember how I mentioned that Walmart, GM, et cetera, they're often trying to maximize return on equity. So they want to have as high as possible earnings per share, et cetera. In the world of these large publicly traded companies, if you exclude the financial sector, the banks, Most of these large publicly traded companies have leverage on their balance sheet of between like 50 and 60% in that range. So they're always using other people's money to a certain degree, but they don't go beyond that because if they were try to push it higher, then the people that lend money would see further risk in that operation, and the cost of the capital would go higher and higher and higher. When people are buying small businesses, though, there's often some government intervention in the normal debt markets. So, if, for example, in the US, if you go to get an SBA loan to buy a small business, it doesn't matter if you borrow 50% of the purchase price or 90% of the purchase price, the interest rate is the same, which would never exist in a free market, right? Because borrowing 90% to buy a small business is obviously much riskier than borrowing 50%, right? And so it skews the market, and it often creates an enticement for business buyers to apply higher leverage because this is going to boost their return on their equity, which is very small when they do an acquisition. Remember, the interest expense is not part of the EBITDA or STE calculation. And so this is why, a lot of my warnings on this channel about business acquisition are that you have to look at the actual performance of the business post acquisition and do a cash flow forecast to figure out how much money you're going to be spending on interest and taxes and capital expenses and all that kind of stuff that sort of gets ignored in the EBITDA calculation. And so, um, just two stories before I wind up. So the first story was when I was talking one day with a guy who did small business finance brokering. So they were helping people get money for small business. And we were having a conversation about merchant cash advances. And if you've ever, actually, if you go to endmymca.com, there's an interview there that I did with a guy named Kenny who helps small businesses get out of merchant cash advances. So if you're in that quagmire, if you've borrowed money from one of these merchant cash advance people and you realize just how much it's costing you, like literally they'll suck all the profit out of a small business because the cost of the money is so expensive. And if you go to endmymca.com, you can learn there how you can get out of it. But this broker was explaining to me, hey, if somebody's got an opportunity to save a bunch of money, for example, on an inventory acquisition, then even with the high cost of the merchant cash advance, it can make sense to do it, right? And what he was describing to me is exactly the scenario that I described to you with the person buying 3 months supply of material with a credit card to try to get the lower price, right? Now, the problem with that kind of thinking when it comes to merchant cash advances is that the cost is just so incredibly high that everything has to work out just perfect in order for you to actually get ahead through doing one of those things. And there's actually a video that I made years ago called how expensive is merchant cash advance, where I actually do it on a whiteboard and I calculate out the costs and everything that you might want to check out. Um, the second story that I want to tell you is about someone who was a long-term operator who wanted to maximize their lifestyle. So I was doing an evaluation of the business because I was going to help them put a price on it. And what they gave to me were 5 years of financial statements. And in the first 3 years, they were reasonably profitable within the expectations of that industry. So they had, profits every year of like 10 to 15% of sales. And then in year four, the profits declined to almost nothing. And in year five, they were almost nothing. And so I asked the seller, I'm like, what happened last year? Like, how come all of a sudden you're no longer profitable? And what he said to me was, well, I paid off the bank loan. So because I didn't have that bank loan, I didn't have the covenants forcing me to submit my financial statements to the bank. So if I didn't need to show the profit, why would I? Right. And so what he was expressing in his own words was that the only reason he was operating, in a transparent fashion, showing the true performance of the business was because he had bank covenants to respect. And he didn't want the bank to call his loan, right? But once he paid off the bank, he decided that he was going to try to minimize his tax burden, which meant jamming a bunch of personal expenses in the business. Again, not legal activity at all. But this is the kind of thing you run into in the world of small business all the time. If you are behaving that way in your small business, if you're putting all kinds of personal stuff in to try to reduce your net income and reduce your tax bill, and you decide you want to sell, it's going to put an extra burden on you because you're going to have all these add backs and adjustments trying to show a buyer how much money the business really makes. And the buyer may believe you, right? But the problem is, will the buyer's banker believe you? And that's the more difficult part of that whole scenario that you put yourself into. And so, is it still possible to sell a business like that? Yep. But not under terms that you're going to like, because that buyer is going to have a really hard time getting money and you're probably going to end up having to finance the deal entirely. I've seen it dozens of times. It happens all the time, right? Because every buyer you find is going to be told no by their banker. So if you want to sell a business, as much as possible, you should be running things as clean as you can, showing the true performance of the business. And you should be trying to maximize the performance of the business so that it's easy for a buyer to show their banker that making a loan to them is going to be a sensible business move. And if you're going to be buying a business, you want to make sure that you have a forward-looking forecast that shows exactly what the performance of the business is going to be for you based on your financing activities and your financing strategies. So again, where you're borrowing the money, how much it's costing you, what investor money is going to be in the business, whether it's your own or other investors that you bring on board. And if you need help with that, if you head over to bizplanschool.com, that's bizplanschool.com. That's where you can learn more about my cash flow forecasting and business plan writing program. And it's highly acclaimed by past students, all kinds of really fantastic and positive reviews, even from people who've gotten MBAs at university, who largely get back to me and say, wow, I can't believe I have an MBA and I didn't learn this stuff. So it's all about how to create a cash flow forecast from scratch. And I would direct you there if you're getting into business or buying a business, even starting a business. The cash flow forecasting program can help you out a lot. And with that, I'll say thank you very much. Thanks for joining me today, and we'll see you next time.
So, how can you learn more about buying, selling, financing, and managing small and medium-sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.